You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we want to cover two industry developments. First, the Chicago Board Options Exchange has received SEC approval for extended trading hours in SPX and VIX options. In the past, trading hours for these two option products was done from 9:30 to 4:15 Eastern Time. Going forward, the new extended trading hours will begin at 3 a.m. and end at 9:15 a.m. Eastern Time, in addition to regular trading hours. The other item of note has to do with the industry's ODD, the Options Disclosure Document. This document explains the characteristics and risks of exchange-traded options. Copies can be obtained from your broker or the OCC and are also available to download online. One place to find the ODD online is at www.optionsclearing.com/about/publications. Now, what's new about the ODD is that the online version now has a search feature. As many of you may already know, this rectangular-shaped document with supplements is over 180 pages. So adding the search feature can save investors a lot of time when referencing different parts of the document. Searching is easy. Pull up the doc online. Right-click on the document. A window will appear 3/4 of the way down, and in that window, you'll see the word Find. Click Find, and a small box will appear. Enter the topic you are looking for in the search space, then hit Enter. I tested this by entering the term out of the money. Find took me to page 124 of the ODD, and that's the first place there's a reference to out of the money in the document. I can then hit the next button or the previous button to find other out-of-the-money references in the ODD. So that's how the Find search works. The ODD really is a very useful educational document. Check it out, and by all means, remember the new Find function. That's it for today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Andrew Giovanazzi, Chief Option Strategist at Options Pit. Welcome, Andrew.
Hey, Joe. Good to be here. Thanks for having me.
Hey, thanks for taking the time to join us. I know you've been in this business quite a while, and you have, I'm sure, some good facts, figures, and stories for our listeners here today. Tell us a little bit about your journey in this industry.
Well, I'll tell you all the stuff that's fit for the radio show. How about that? That's a good start. That's a good start. The journey started in 1989, if you can believe that. I hard to believe it's like 26 years ago, but out of college, I basically needed a job. I was looking around, and I know that San Francisco, I went to school at UC Santa Cruz. San Francisco had a trading floor, stock exchange, so I figured I'll just walk in there and see if I could find a job. So that's basically what I did. I got a job at the exchange as a quote operator in, I would say like the summer or spring of 1989. And in those days, I think, as you recall, Joe, all the quotes went up on an electronic screen, but you actually had to physically have somebody there typing them in on an old Quotron machine. The old blinky green Quotron machines. And that was a quote operator's job. So I did that for 6 months. So I gave the exchange a 6-month commitment. And while I was a quote operator, I basically started, listening and hearing, you're on a trading floor. I ended up on the options trading floor just by chance. And, you start learning things. You sit there and you're kind of immersed in what's going on. And, after about 2 months, you kind of figure out how to put the quotes up. And you start being able to hear what's going on. So you're hearing the trade go on. What happened was, after a while, I started to understand a little bit how options worked. So one time I remember pretty clearly, there was a market maker that sold some calls. I think they're about $1. I think it was Castle and Cook even at the time. And he sold like 100 lot for $1. And at the end of the week, they went out worthless. And I thought to myself, that guy just made $10,000 in a week.
So no risk.
I know exactly. No risk. You just take your wheelbarrow and you drive it in, you fill it up with money. So I was young. I was like 23 years old. So I go, I want to do this. This is perfect. You just show up and make money. So a couple of,
I was going to say, how long did you stay at the P Coast?
Working for the exchange only 6 months. I actually got a part-time job with a trading firm that was new at the time, which was Group 1, running sheets and stuff back then. There was a lot of manual work to do. So I stayed with the exchange for 6 months, but then I went to work for Group 1, and then about a year and a couple months later, I was trading. Where you on? They were leasing me a seat in San Francisco.
And full speed ahead. Were you on the P Coast back in the late 90s when all heck was breaking loose?
I actually was. I stayed on the P Coast for a year and a half in the very early 90s, like right around Gulf War I. And then I went to Chicago to run a DPM post there for 6 years. I basically started the post there, started an education program at Group 1 while in Chicago. And then I went back to San Francisco in 97. And I stayed there basically for the last, for 10 years after that.
Those late 90s, it just gives me goosebumps. I mean, the P Coast was the mecca back, for the NASDAQ, the first NASDAQ run to 5,000.
Yes, it was. To give you an idea, in the early 90s, an exchange seat at the PSE went for like $15,000. By 1998, it was $500,000.
Yeah, they were remarkable times. They were times when everything was still singularly listed and there was no electronic access to the markets. I mean, absolute insanity.
It was fun. That's all I can say. It was a lot of fun. And as time went on, I left Group 1 after a while, and I formed my own little group with a friend of mine, and we had a good 6 years until basically electronic access, when the ISE came in, and it was basically became kind of a computer-driven marketplace for market making. It was kind of like, I kind of could see the writing on the wall. To compete, you needed quite a bit of capital, like factorial more and more technology. And that's when I just decided basically, retire from trading and, figure out what else I wanted to do.
Well, clearly, it sounded like you had a passion for the educational side as well. You spent 6 years with Group 1, I think, in that capacity to a point. Tell me a little bit about how you've evolved as an educator in the business, and then also how you joined forces with Mark Sebastian at Options Pit.
Okay, so this was a good story. So I met Mark when we were both writing content for TheStreet.com. At the time, I was working for a software company, a startup that was trying to develop 3D modeling for financial applications. And what happened was I talked to Mark, and I went to his website, and his business was brand new at the time, and he was a mentor. And I looked at what he was doing. I'm like, wow, this looks awfully familiar. And what I realized is that Mark actually was a market maker for Group 1, and he had learned trading on the program I helped set up at Group 1 10 years earlier.
Small world.
Yeah, so it was wow. I go, this is kind of cool. So what he was doing was he was taking sort of market maker trading technique, and I saw what he was doing. I'm like, wow, we could really take, how basically market makers survive, right? Because they end up with a lot of positions they don't want.
Right.
And you have to kind of come up with a technique of managing those positions. So at Option Pit, what we've done is we took market maker technique and try to translate it into more retail accessible trading. So like an iron condor to me is just a short gamma trade or a short vega trade. Or an iron butterfly is a short gamma trade with lots of short gamma. So what we've done is, take what, we learned, or how I taught, floor traders how to trade as a floor trader, and translate into more accessible content for people just learning about options, or they want to invest, or whatever they want to do. And it seems to have it's gone pretty well so far, I have to say.
Well, that's dynamite. And actually, this really is a real good opportunity for our listeners to tap into some of your educational expertise. Would you say that can anyone be a good investor? Should everybody use options? Talk to me a little bit about that.
Well, I think the important thing about using options is to have a reasonable expectation for what's possible. And understanding the difference is, okay, I was good or I was lucky. And
what about I was bad?
Or I was just bad and stupid. The second part is basically disciplined. If you cannot generate a disciplined routine for yourself, using options, you're going to find it very difficult because, of the nature of how stock options work. If you're a disciplined person, you apply some discipline to it, you should be able to do okay, as long as you understand how options work. So I think to be a good investor with them, you need to use the products in the way they are designed. And probably one of the biggest things that we face at Option Pit is a lot of clients come to us and they use the products in a way that they were not necessarily designed to be used, or they try to get too much out of a strategy that they were looking for. So basically we try to, teach basically trying to add some control to somebody's technique or how they invest. And, don't forget using the risk and the reward part of the equation, to allow people to to profit and make money with options when the conditions are right.
Walk me through an example or two how an investor, might use options, how they're not supposed to be used. I don't get that.
Okay. So let's say you have a stock that's running, okay, and you want to be long. So what you do is you aggressively write puts against the stock. Okay. So let's say you have a biotechnology stock that's up, $40. And you say, okay, this $5 out of the money put has $10 worth of option premium in it. I'm going to sell it. And that certainly could work. Okay. Almost anything you do with an option could work once, maybe twice. The problem is you sell a put, right, that has decent premium, but it also has a much higher risk of having the position blow up in your face. So when I say people using options, how they're not meant to be used, it's, are you using them in a risk-controlled fashion, right? Anybody can sell options that have margins. So what we try to get people to do is, when you trade an option, are you making the most risk-controlled trade with the kind of return you are looking for, right? Because if you basically put on trades all the time that have infinite risk with some reward, you're only going to last so long. It's hard to do.
No doubt about it. Yep.
So what we try to do is, okay, if you're going to sell puts, fine. Let's sell put spreads. Let's do something to add some control to the position so you don't have a totally open leg. And I certainly sell puts when I think the time is right, but I sell puts when I want to own the stock. So you've got to be real. You just have to be very exact on what you're trying to do with the option and what the end delivery is going to be.
How do you narrow the universe? There are so many different types of option strategies out there. Do you come to the table with a handful of strategies, or does it depend on the investor who's coming to you?
Right. What we do is we teach something called what we just named conditional trading, meaning for any volatility circumstance, there is probably or most likely an option position that will fit that best. That could be a butterfly, could be an iron condor, it could be a long straddle, you could be short a straddle, anything, any combination. So what we do is we want to make sure that the trade that somebody is looking at is going to fit the conditions in the marketplace that exist at the time. So what that takes is some education on what a volatility condition in the marketplace is. We have high vol, low vol. Is the realized vol very high? And what we find is clients naturally have an inclination. Like, I have some customers that never buy options ever. Okay. And my job is not to tell people, what to do. They have a natural inclination. I have other clients that like buying options, maybe time spread stuff like that, because they like the control that it gives them all the time. So what we try to do is create risk-controlled strategies based on conditions that people then go use. So we just teach them about the different ways option strategies will work around, let's say, the difference between when VIX is 12 and when VIX is 35, right? Two totally different animals.
And so that market condition brings certain strategies to the floor, and so does that client's tolerance for risk?
Exactly. And we basically try to put all that together. So what we do is we have general education. And then when we have kind of like mentoring sessions and things like that, what does the client like to do, right? And here are risk-adjusted ways to look at that. So they want to get long Apple, but they don't want to own options. There are risk-adjusted ways to do that. They like the market, but they are not comfortable being net short premium. Okay, let's say. There are ways to do that. So we help the client making sure that what their intention is, the position matches the intention. And that's probably, if I have to say one thing about use of options right, is you want to make sure that the position you have matches the intention that you want to see play out in the marketplace. And I still think that's education has obviously a pretty solid role to play there.
Makes sense. The name of this segment is Strategy Spotlight. You want to, focus on one particular strategy for our listeners and get into it a little bit from a risk-reward standpoint, whatever you'd like to speak to?
Sure. So we had so this was just recently, is understanding, let's say, a time spread or a calendar spread. So we just had VIX drop down to, let's say, it traded at 1260 last week, pretty low print for volatility. So there's a couple of things, right? So when volatility gets too low, we're kind of old school, right? When things get low, I like to be a buyer. When things are relatively high, I like to be a seller, as just a net idea. So trying to have, when people understand how a time spread works, time spreads are kind of two things at once. One is you sell that forward contract. So it has, a positive theta aspect. It's generating decay. But you're also buying a back month contract, which means you're net long volatility. So if you get kind of a volatility spike, the value of the position should go up a little bit. So when we're looking at, at a low VIX, high market, trying to place some out of the money put time spreads starts to make a little sense, because you're kind of playing for maybe a little rise in volatility. You're looking for a possible move down on the market. But even if you don't get the move down, because you sold the forward contract, the decay should also help pay for the position. So what you do is you create kind of a zone or a tent of activity where the position can still be profitable from. So, when volatility gets really low, time spreads all of a sudden become a lot more interesting, because the risk you have to take from a change in volatility or volatility going down is a lot less than it might have been when VIX is trading 35. So for the exact reason time spreads look good when VIX is 12, they're an awful trade when the VIX is 35.
Let's see, two kind of thoughts. How much time between the front month you sell and then the option that you buy? Is it next month? Is it a couple months out? Does it vary?
So it does vary. And I think what varies on it is how much exposure to underlying movement you want. So the general rule is the closer you put the terms together, the less short gamma you have. Meaning if you do sort of weekly terms, the position is relatively shielded from movements in the underlying. You're still going to be short a little gamma, but not near as much as if the term is, let's say, 6 weeks apart, where, a smaller moves in the underlying are going to make a big difference to the P&L of the position. So what would affect that is how low the volatility is overall. So if I'm looking at, let's say, 2-year lows in volatility, I might want to stretch that term out a little farther, because I want to pick up that exposure to volatility. If I'm looking at maybe something a little more short term, where let's say the volatility is kind of in a middle range, I might want to push that term, those terms together a little closer, because as you push the terms together closer, you have less gamma risk, but you also have less risk with volatility. So the big determinant for me is ultimately how low is the implied volatility overall for a type of time spread.
And the target for that long out of the money time spread is what at expiration or close to it?
So an out of the money time spread, generally what I think of, the easy rule for time spreads is you place them where you think your underlying is going to go.
Okay.
So if I'm
say that again, that's important.
Okay. So when I'm looking at a time spread, this is talking about a long time spread where you buy the back month and you sell the forward month. I place the time spread where I want the underlying to go, right? So if I'm buying, and it'll be calls or puts, because basically a call or put time spread is the same thing, less the cost to carry. So If I buy an out of the money put time spread, I'm thinking I want the underlying to go down to it. So it's naturally bearish. If I buy an out of the money call time spread, I want the underlying to drift up to it. The trade is naturally bullish. Okay. Now, depending on how close you put it to the strike, will determine sort of, let's just call it how big the tent for the position is, or what your risk reward profile looks like. If I place a time spread right at the strike, right, I'm saying I don't think the underlying is going to move a whole lot. So what you do is you have to have the intent of the trade set up, long before you ever put the trade on. So if I'm a little bearish, right, but I still want some room, I'll kind of snuggle a put time spread up a little closer to the money, right? Not super far out of the money, but kind of closer to the money. And if you think about it this way, if you put those time spreads way far away from the money, okay, you're expecting, or you need, a huge move in that direction to make them work. So just by where you place them, what that does is that automatically tells you what your intention is going to be, whether you want it to or not. And that's how I think about, setting them up. So when we're in kind of a low vol environment, I don't want to really be a volatility seller, mostly because, and just like it happened this week, we had VIX ran from 1260 last week to, 16, almost 17 today. I'm not interested in what we'll call being short Vega when VIX is so low. I don't want that position. That's why trades that are kind of similar to a time spread appeal to me. And we have way many more variations of time spread that we can talk about here, because we do a lot of adjustments and we kind of trick them up, making them operate a little differently than normal. Again, that's from market maker experience. Sometimes you want to add gamma to something. So we use that technique and we kind of change how the time spreads work a little bit. But that's the idea, right? So you want exposure to certain things with a time spread, just like when I talked to you about intent. If I buy a time spread, I have a specific intention. I think I want that back month vol to rise, and I want to try to collect some decay in the meantime. And depending on where you place it, you add a directional component. So there's kind of three parts to them.
Really good explanation, and it kind of under the surface, so many of these positions that seemingly maybe somebody getting started may think is somewhat close to a hedge position. You spoke clearly to the difference with a couple of the Greeks, that short Vega component versus that long Vega component, and balancing off the two depending on, the amount of time between the option you've sold and the option you've bought. So well done, Andrew. Good discussion on time spreads there.
Well, thanks. That's basically, that's what we do every day. We do a lot of position discussion, trying to improve positions. And when I say improve positions, like nobody can, I don't think anyway, could just tell you what's going to happen, right? But what you can try to put together is a position that generates the best risk reward profile that you think you can based on what you want to try to do. The good part about options is, they're essentially infinitely flexible. So, when I'm looking at a time spread, what I do is, it's not that today's a Tuesday and I'm looking to put on time spreads. It's the volatility is doing this, and time spreads seem to work better under those conditions. So I kind of work things around differently from the strategy point of view, as I'm a butterfly trader. What I am is, I like the idea of a butterfly under certain conditions, but I prefer the market to get to that condition first before the strategy actually kind of presents itself. So I think, anyway, in the way we think about it, Option Pit, we do things a little bit opposite like that. We look at the condition first, and then what type of strategy has the best chance of success given the conditions that we see.
Yeah, I like that approach. Before we wrap it up here, I really would like to ask you, since you've been in this educational game so long, and you talk to investors day in, day out, are there certain mistakes that you see over and over, or what about the mistake side of the game for investors?
I think that I do the same thing. It's taking profits. One of the things is, options have finite lifespans, which means it's not like you buy a stock and you hold it for 25 years. Okay. You have an option that has a lifespan. So in general, for the strategy and intention you have to have a reasonable exit point. And when it hits that spot, take your money, go on to the next thing. At the same time is when things go bad, sticking to an exit. Okay, if there's something that you put on, for whatever reason it's not going right, I prefer to have defined loss spots, and when it hits it, I just close it and go on to the next thing. Because it's very easy to sit and wishing your way back to profitability. It's one of the 4-letter words I don't like when I'm trading or using options. Wish, need, want, and hope are the 4 words you don't want to have to say when you have a position on. Normally when you start saying one of the 4, things are not going right, and you probably should be hitting the exits. So, that's probably the number one thing, is looking for a reasonable exit. You're up money, close the trade, move on to the next thing. That would probably be the number one thing I see. The second part is, I would say, not basically having most people just not really educated on how an option is going to work. So they try to kind of push or probably take too much risk with options that they should. The third one would be on maybe margin side. People have portfolio margin. They tend to take too much risk with portfolio margin. It's a bit of a loaded gun, so I want to make sure that they learn to use the margin in a right way, in a risk control way. And I think those are probably the 3 that we see most common.
Well, I hope listeners, you're hearing Andrew, and if some of that hits home a little bit, you may reach out to Andrew, or at least take a good look in the mirror to see if you can correct some of those more common investment mistakes. So, Andrew, Strategy Spotlight, it's been great. We rolled into time spreads, talked a lot about your options pick business and your expertise in education. Just want to thank you for joining us today.
It was a pleasure, Joe.
We'll see you hopefully one of these days out on the road.
Will do. Take care, Joe. Bye-bye.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives, we're thrilled to have Ed Boyle, new CEO at the Box Exchange. Ed, thanks very much for joining us today.
Thanks for having me here. It's always a pleasure to do these shows, and I enjoy getting out to our listeners.
And our listener base, essentially, we're talking, a retail group that joined us here at OIC's Wide World of Options. I know some other management changes for you at Box. Lisa Falls has joined you as president, I guess, now?
Yep, and I was just recently appointed CEO of Box about a month ago, and it's a transition that has been very smooth. My predecessor, Tony McCormick, is still involved. He's still part of Box, and we look forward to continuing to work together. We've got a very good staff over here.
Well, why don't we just talk about Box for a little bit? I mean, you got a history, I guess, goes back to maybe 2004. You've been with Box maybe since 2012.
Yeah, I just joined Box recently in the last couple of years. I've had a rather eclectic history as a broker, trader, on-floor, off-trade equities, options, multiple asset classes globally as well. So it's I entered the exchange space working for the New York Stock Exchange a few years back and ran their option business. And now at Box, I'm basically here to see if I can't apply some of what I've learned and what I've done to Box to make it a continue on its path of success. Box has always been an industry leader in a lot of areas. Box was founded back in 2003-04, and it was really brought to the marketplace to provide the retail investor with the opportunity to price improve their orders. At the time, there was no such thing as, I shouldn't say no such thing, but we didn't have pennies in options yet. But options were still traded in nickels and dimes, so there were wider spreads, and retail orders didn't have the ability to get improved beyond those prices. Box brought what they call PIP to the marketplace, price improvement process, and it's an auction methodology. They were the first to do it, and they ran it for a few years. It was a bit controversial early on, but it provided a lot of value back to investors. And on our website, we demonstrate that every day through how much money investors save by trading in PIP. PIP is a process by which the routing broker, or the broker for the retail investor, can enter that order into an auction process. Other participants can respond to it and improve upon the quoted spread. The orders are stopped at the quoted spread. They never will trade outside of the quoted spread and only have the opportunity for price improvement. So it was a very big value for the industry.
There's some incredible stats that maybe we'll get into, but how long is the auction, Ed?
The auction currently is a 100 millisecond auction, and that's been from back in 2004. And I may be wrong on the numbers, but I think in 2004 it was a 3-second auction. And while that may not seem like a huge difference, it is from, or maybe some 100 milliseconds may seem too short to even interact with. For electronic systems, it's they generally can respond in less than 10 milliseconds, in many cases microseconds. It's just got to do with the speed of light over networking.
Far different from the auction market on the floor back in the day for you and I.
Yes, I remember when you were getting a fill in under 3 minutes was a good fill, particularly for the equity markets. So it's a very different and very evolving marketplace, but it's also created its own challenges, which we've seen in the last few years through things like during the financial crisis we saw a lot of hype around what is deemed high frequency trading and things like that. And while the option business deals with some of that, it's not people tend to look at that or use that connotation negatively, and I don't think it's always negative. I think there's behavior out there that we could possibly make better, but there's certainly nothing wrong with the markets, or as some of the books have put it, rigged. The markets are certainly not rigged at all.
I couldn't agree more. Let's go back to PIP just a little bit to be sure that our listeners get it. You did a good job explaining it, but the markets basically have an NBBO, National Best Bid Offer, and that auction occurs inside of that NBBO. And I think just in doing some homework, it was remarkable to me the percentage of option orders that actually trade on box that are PIP improved.
Yeah, of the marketable customer orders. So of course, an order that's away from NBBO can't trade in a PIP because it's simply sitting on the book waiting to become part of the marketplace. Orders that are entered into the market that are marketable or are in fact market orders, generally in many markets they will just trade. If the market is $1 to $1.05, they're going to trade it. If they're selling, they're going to trade at $1. What PIP does, or as well as other auction methodologies, is they say, hey, let's instead say, okay, we're going to stop the customer at $1, or in other words, guarantee him a fill at $1, but we're going to offer this out electronically to all the participants and say, does anybody want to pay more than $1, maybe $1.01 or $1.02? And currently, the latest statistics are that retail customer orders, somewhere around 90% are entered into auction processes that are marketable orders. And not all of them get price improved, but it's probably up in the, I don't have all the auction data for all the exchanges, but it's probably somewhere in the 70% range.
Okay, pretty impressive, and just another great value add for the clients.
Yes, it is. It's absolutely been great. Retail customers get get fairer and better pricing and options today than they ever have, and that's that's continued to happen. We're also seeing somewhat of a concern in the markets, and we're seeing wider spreads. And of course, auctions bring more value to that. Some will blame auctions for creating wider spreads, but it appears to me that auctions are auction growth is more of a response to wider markets than is creating wider markets. It's a bit of a chicken and egg problem. Mm-hmm. So again, it protects the retail investor, is who it really protects, no matter what the market conditions are.
And I think, we both go back a long time in the industry. We referenced it earlier, kind of that floor trading, mentality. The markets now for the retail investor have just never been better, be it the level of technology, be it the number of exchanges, the cost efficiencies. I mean, it really is a great environment for the investor.
I couldn't agree with you more. The tools that are now online with retail brokers like Schwab, E-Trade, Fidelity, Ameritrade, I could go down the list, are incredible. The tools retail customers have access to today are far superior to the tools that I, as a professional trader, had in the late 2000s.
I agree, and it's remarkable.
Yeah.
How about the user base for options? I think it is expanding. Do you get feedback from your participants as to, who exactly is the new people getting involved in the option space?
Yeah, this is another area that's difficult to get quantitative data out of, because it's just hard to go out and know exactly who is trading. Not all the firms are going to give up their demographic and how the research goes after different clients. But we do see the more sophisticated or more engaged retail investors are the ones who like to trade options, because they are a more sophisticated product. They're not overly sophisticated, and there's a lot of ability for education out there, which can always be furthered, something OIC does very well. And right now, the user base that we feel is the most, from the retail perspective, is the most prolific is in that 30 to 45-year-old range of people, particularly upward of that when we see people who grew up around the markets. The concern we've got is that we don't see a lot of younger people trading them. Where 10 years ago you did see college age or very young professionals trading more and more options. The latest studies I've seen, and I'm not going to say they're all perfectly accurate, are showing that that is not a growing area. It's kind of stagnant, and we'd like to see some growth there. And I think that education and all of the exchanges and the marketplace contributing to it can help. But we've also got to be able to stamp out these negative media hype that's out there with books like Flash Boys, which is a great story, but it's a story.
Yes.
The underlying piece of it isn't that the markets are in fact rigged, although they like to say that. We really got to make certain that people understand the markets when they're going to participate.
And I think possibly for the younger set, there may still be a hangover for investment period coming out of the 07, 08, 09 financial crisis.
Agreed. And as well as a lot of people that are, if we go into that older age group, or that more maturing age group, a lot of people got hurt in that financial crisis, and now they're in protection mode. And they, again, if they were, with education, options would be a fabulous, highly protective income stream for them if they would use them properly.
Yep. You talked about the box. Your foundation is growth and new development. Tell us about the new product you're talking about bringing online. This idea of the real vol SPY options.
Yeah. So we feel that this is a product that currently, as we all know, VIX is the main volatility product that's out there to trade and freely trade. It's got a lot of liquidity. It's a great product. We're launching, VIX is an implied volatility product. We're launching a realized volatility product. So it actually tracks the realized volatility of the underlying, not what the market is implying is going to be the forward pricing of it.
Well explained there, that implied versus historic differential. Well done.
Yeah, that's a difficult one to comprehend well, but implied, or the VIX, is actually, when you're trading it, you're trading implied of implied, and it settles to implied. Realized, you trade implied, and it settles to realized. So it's a bit complex, but not really once you get used to it. It does give sentiment of the, the fear index, as it's like to be called. We see realized as actually being a complementary product to the whole idea that volatility is looked at as an asset class. It's not really an asset class, but it's looked at as one. And we feel that this is a very complementary product. We think there's a lot of other opportunities for other volatility products out there, and that can add to more and more people having access to these type of products that give them the ability to hedge and trade that volatility swing.
And you're going to have two different elements maybe with this, a daily and a real time. Is that right?
We're getting ready to launch it. We just were approved by SEC yesterday, so we're given approval to do it. We can launch dailies, weeklies, monthlies. So, we've got all the strikes there. The question is, what do we do? What we're doing now is going out to the participants, going out to the liquidity providers and the users and saying, what would you like us to list? We don't want to list things and unnecessarily put things on the screen that aren't going to trade or that are just going to be a burden to the marketplace. What we really want to do is put things that people want. So we're currently gathering that information now.
Okay. And how would a retail investor trade the real vol? Walk us through that application if you would.
It would look a lot, so in order to actually make the trade, it would look a lot like the VIX product looks on the screen. You'd have what volatility, so you've got an underlier or an index that creates the underlier. That we're also looking to put a future up on that index. That's one of the things we're doing now with some of the index or some of the futures exchanges. And then what a retail investor can do is say he's got a large portfolio and he has got some concern over where the market's heading. He feels that the market looks very lofty. He feels that he wants to hedge some of that risk. He can go in and put on a volatility position to say, hey, if the market gets very volatile, which puts my investment at risk, I want a return on this other product. And that's where the VIX will come in, or I'm sorry, that's where the vol S, as would be the name of it, would come in to allow them to hedge that. So there's multiple hedging strategies around it. You can also go in and sell the options on it. Again, saying, I think we're going to continue in a low volatility environment. I want to use this as a investment accelerator and do it like that. So it's really seeing what's right for your portfolio and how you want to use it.
And it's going to be called Vol S?
Vol S, like in Sam, yeah.
Okay, very good. Well, Ed, I think maybe just one stat I'd like to throw out there before we wrap up. You were talking about PIP early on, and I think you're up to over $600 million as an exchange in savings for the retail investor.
That's exactly right. We're right in the 640 area, I believe it is right now, since its inception. And so if you do that math backwards, we're saving investors some area of $50 million a year in their executions. And that's an incredible number. A lot of people, when they look at the market, and this goes back to the whole idea is how efficient is it? We've now created a very efficient marketplace, particularly for the retail investor, where they're protected when they come in, they're protected on their way out. It's just a great product.
Well, Ed, CEO at the Box, I want to thank you so much for joining us today on Profiles and Perspectives, and wish you all the best.
Thanks for having me on. I appreciate it.
It's time for a nostalgia break. It's time to take a look back.
Today's Looking Back will take a high-level view of electronic trading in the listed options market and how it has impacted the marketplace. At the turn of the century in the year 2000, the first electronic options exchange, the ISE, was launched. I'd been a trader on the floor of the Philadelphia Options Exchange for almost 20 years at that point. Lots of things changed when customers got electronic access to the options market in the year 2000. Now, also at that time, exchanges started dual listing companies' options, which meant a customer could trade options on all or most of the exchanges rather than just one options exchange. This combination of improved access to the markets, coupled with more competition between exchange participants on option prices, led to faster executions and better prices. Option volume soared. Now, another factor adding to improved access were improved platforms offered by brokers. These new platforms, combined with electronic access to a more competitive options marketplace, put the listed options industry on a dynamic growth path. The combination of these different developments has really greatly improved the efficiencies of the marketplace. That's it for today's Looking Back.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we're going to start with a discussion of the Relative Strength Indicator, or RSI. This is a momentum indicator that compares the magnitude of recent gains in an underlying to recent losses. The goal of the indicator is to try to determine overbought versus oversold prices of that underlying asset, whether it's a stock, index, ETF, whatever that asset may be. The RSI readings range from 0 to 100. Now, generally speaking, levels of 70 and 30 are thought to be warning levels for potentially overbought and oversold conditions. It's extremely important to realize that these readings can stay above 70 and below 30 for long periods of time, allowing for significant additional gains and losses in that underlying asset. The RSI is best used in combination with other technical indicators, some of which we've discussed before on Why World of Options, and others we'll be covering in the future. Now, the resource I want to mention, and I've probably mentioned it before, is Yahoo Finance, which is found at www.finance.yahoo.com. Too many features here to mention, but one area to check out is on the left side of the page. Hit Market Data, then scroll down to Options, and at that point, just have fun exploring. There's lots of good information, including various option statistics and also option-related news items. Lastly, I wanted to mention a series of books recommended to me by colleague Michael McFarland. Trading Price Action by Al Brooks. This three-part series, with a book on each topic, covers trends, reversals, and trading ranges, all very important topics in the trading space. Thanks for joining us today on Tools, Resources, and Good Reads. And don't forget to check out the OIC website at optionseducation.org for upcoming live seminars and webinars. Good trading, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.